get ready, because we're doing a deep dive today into factoring.
Factoring.
Which is a way for businesses to get funding.
Right.
That most people don't really even know about.
Yeah.
So we're going to try to clear up some of that mystery today. And, specifically, we're looking at this as an alternative financing option. Right? When you can't get a traditional loan.
Right.
What do you do?
Right.
And so to help us with this, we've got an expert here.
Oh.
So let's just jump right into this thing. Our sources painted this picture of all these businesses struggling.
Yeah.
With debt and unexpected costs and things like that.
Yeah, it's tough out there.
Yeah, we've got this one commercial printer just like drowning in debt from an acquisition they made.
Oh, wow.
And then this security software company just reeling after like a merger gone wrong.
Oh.
And then this consumer electronics manufacturer dealing with like a ton of product returns. And then on top of that, just this whole economic climate.
Yeah.
From the pandemic.
Yeah.
Banks are a lot more hesitant to loan money.
Right.
So, what do these companies do?
Right. Well, that's where factoring comes in.
Okay.
So imagine a business owner, they've got all these invoices, right?
Yeah.
They've delivered the goods or services, but they're just waiting to get paid.
Right.
Could be weeks, could be months.
Right. Like they have all this money that's like on hold.
Exactly. And they have bills to pay in the meantime, right?
Right.
So that's really the core problem that factoring solves.
Okay.
Instead of just sitting there waiting, businesses can sell those invoices to a third party, who we call a factor, at a discount and get cash right away.
Okay, so wait, so this isn't a loan?
No, not a loan at all.
Interesting, okay.
It's more like selling an asset, right?
All right.
You're selling that invoice for immediate cash, and the interesting thing is that it's actually way more common than people realize.
Okay.
Over $100 billion worth of invoices are factored in the U.S. every year.
Wow, that's a lot. Okay, so let's break this down a little bit. Like, how does this actually work?
Sure.
Like, walk me through this.
So we've got this guy, Chris Lenz, who really is a factoring guru in the source material. And he lays out 6 kind of main steps.
Okay.
So the first one is obviously got to identify a business, right? That has these outstanding invoices, needs quick cash. Then we go into all the paperwork. Submit an application, you get a proposal from the factor, sign a factoring agreement. Usually there's a small application fee. Then the factor has to put on their detective hat.
Okay.
And go through a review process. We call it underwriting. The client provides, all their invoices, aging reports, all that stuff.
They look at everything.
The factor's going to do their credit checks, make sure the customers are good for it.
Got it. They're checking to make sure the invoices are actually worth something.
Exactly. Okay. And if all that looks good, we go to closing and funding. So they purchase the receivables and then they advance a percentage, typically around 75% to the client right away. Up front. Then once, customers pay up on those invoices, they'll pay the remaining balance less their fee to the client.
Okay.
And then usually they just roll over, continue purchasing new invoices as they're issued.
Okay. So this all happens pretty fast.
Oh, yeah. Super fast. I mean, we're talking within a week. Often.
Wow. So for a business that's like really hurting for cash, that's got to be a lifesaver.
Oh, yeah, for sure.
Okay. So let's talk about the fees, though.
Yeah.
Because I feel like that's what people get a little, concerned about.
Yeah, it can seem a little high. Typically, it's around 2.5% per month.
Okay.
On the outstanding receivable balance.
So that seems a little high compared to a bank loan, right?
Yeah, it can seem that way, but, you got to keep in mind the benefits, right?
Okay.
The speed, the flexibility. It's not something you get with a traditional loan.
Okay, so what happens, though? What if a customer just doesn't pay the invoice?
Right. So that's where we get into the weeds a little bit.
Okay.
There's 2 types of factoring. Recourse and non-recourse.
Okay.
So with recourse, if the customer doesn't pay the business, one that sold the invoice, they have to pay the factor back.
Oh, okay.
Kind of like, co-signing a loan for a friend.
Okay.
But with non-recourse, the factor, they take on the risk.
Okay.
So if the customer doesn't pay, they're out the money.
Gotcha. So like non-recourse is like you're paying for a little insurance.
Exactly. And this Versant funding, they're actually mentioned a lot in the source material.
Rick.
They specialize in non-recourse.
Interesting. Okay.
Yeah.
And you were saying you don't need good credit to qualify?
Yeah, that's one of the cool things.
Okay.
They actually care more about the customer's creditworthiness, the person who's going to be paying that invoice.
Right. So it's like if you're a small business, you're selling to like Walmart or something.
Right, exactly.
It's Walmart's credit that really matters.
Exactly. They're betting on Walmart to pay, not necessarily the small business.
Gotcha. Okay.
And don't worry, big companies like Walmart, they're used to dealing with factors.
Okay.
It's not a red flag for them or anything.
Okay, that makes sense.
Yeah.
But why would a company even go the factoring route?
Right. So there's a bunch of reasons. Chris Lenz mentions a bunch in the material.
Okay.
One of the big ones is rapid growth.
Okay.
Let's say you land this huge new client, but their payment terms are, let's just say, slow.
Right.
You need cash now to fulfill the orders.
Right.
But the bank's not giving you a loan.
Yeah, you're in this tough spot.
Right. So factoring comes in and kind of bridges that gap.
Okay.
Lets you seize that growth opportunity without going into debt.
I like that it's like a financial superhero.
Exactly. And it's not just for emergencies, right? Think about acquisitions. Buying another company, that takes a lot of money. Factoring can give you that upfront cash to close the deal faster and with less hassle than trying to get financing the old way.
Right, right. Because sometimes speed is really important.
Oh, yeah, absolutely.
What else is in the source material?
Seasonality is a big one.
Okay.
You know, some businesses, like in tourism or retail, they have these really busy times.
Yeah.
And then it's like crickets chirping.
Right.
So factoring can help them stock up during the rush and then, you know, stay afloat during the slow period.
Right, like having a financial cushion.
Exactly.
Okay.
And then obviously there's always crisis situations like economic downturn,
Right.
natural disaster, even something like we're seeing now with all the supply chain disruptions.
All right.
Factoring can be a real lifeline in those cases.
Yeah, it's like a parachute.
Exactly.
Okay, so we've covered the what and the why, but like the big question for a lot of people is, does it actually make you more money?
Yeah.
Right. Like even with these fees, can you actually be more profitable?
Right. And that's where it gets really interesting.
Okay.
There's a table in the source material shows how factoring can actually impact your profits.
Yeah.
And the answer is yes.
Okay.
If factoring helps you get those bigger clients, you know, helps you ride out those seasonal swings, you can absolutely make more money overall.
Interesting.
It's like unlocking the cash that's trapped in those invoices, right?
Yeah.
And using it to grow your business.
Okay.
So instead of just kind of treading water, you're moving forward, even when it feels like everything's working against you.
Interesting. Okay.
Yeah.
We're going to take a quick break, and we'll be right back to dive a little deeper into this factoring world.
Sounds good. So are we ready to get back into the factoring world?
Oh, I'm ready. Let's do it.
Okay, so last time we were talking about recourse and non-recourse factoring.
Right, and I think that's where people kind of get a little tripped up.
Yeah, it's an important difference. So let's start with recourse factoring. You know, that's where the business that's selling those invoices, they're the ones who have to pay up if the customer doesn't.
Yeah, so it's like they're vouching for the customer even though they, like, got rid of the invoice.
Exactly, and because of that extra risk for the business, the factors, they usually want to look more closely at the business's financials.
Right. So it's not like a total departure from traditional lending.
Right.
They're still kind of assessing the borrower, right?
Exactly, yeah. And because the factor's taking on less risk, the fees are usually a little lower.
Okay, that makes sense.
Yeah.
All right, so let's talk about non-recourse then.
Okay, so non-recourse is where the factor says, hey, we trust that your customer is going to pay.
Yeah.
And if they don't, it's on us.
So that seems less stressful for the business.
Oh, yeah, definitely.
But I bet it's more expensive.
Non-recourse usually has a higher fee.
Okay, makes sense.
Yeah, you're basically paying for that peace of mind. And of course, the factor's going to be extra careful about checking out the customer's credit.
Oh, yeah, for sure.
Before they agree to non-recourse.
Right, because they're the ones taking the risk now.
Exactly.
So a business that maybe doesn't have the best credit, but they have really good clients, like they're selling to really solid companies.
Exactly. Yeah.
They could still do non-recourse.
Absolutely. And that's what makes factoring so cool.
Yeah.
It opens doors for businesses that maybe wouldn't qualify for a traditional loan.
Right, because it's not all about your balance sheet.
It's about your customer.
Yeah.
It's like they're saying, show me who you do business with and I'll tell you if you qualify.
Yeah, I like that. That's cool.
Yeah.
So remember Versant Funding? We were talking about them before.
Oh, yeah. They specialize in non-recourse.
Right. And they work with some tough cases, right?
Yeah. Even businesses with, you know, credit issues, no track record.
Wow.
Even brand new businesses.
Okay.
Yeah. Chris Lenz, he's the business development guy there. He talks about how they're really looking at potential.
Okay.
The strength of those customer relationships.
Interesting. So they're not just looking at the numbers.
Right.
They're looking at the bigger picture.
Exactly.
Okay, so we've got recourse, non-recourse. Is there anything else we need to know?
Yeah, there's this whole other layer,
Okay.
notification versus non-notification.
Okay, what's that all about?
So basically, does the customer know that their invoice has been factored?
I can see why a business might not want their customer to know.
Yeah, right. So with notification factoring, the customer knows.
Okay.
Like it'll say right on the invoice, pay this company.
Okay, so no secrets there.
Nope.
Yeah.
Totally above board.
Okay.
And, the factor needs to get paid.
Right.
So it makes sense that they would want to be in contact with the customer.
Okay, that makes sense.
So then there's non-notification factoring.
Okay, is that even a thing?
It's less common.
Okay.
But it's out there. Basically, the customer doesn't know that the invoice has been factored.
But is that risky?
Well, yeah, it can be.
Right. What's to stop the business from just keeping the money?
Exactly. Yeah.
Right.
It requires a lot of trust between the factor and the business.
Okay, so I can see why that's not as common.
Right, exactly.
Okay, so we've got recourse versus non-recourse.
Yeah.
Notification versus non-notification.
Yeah.
It's like choose your own adventure for financing.
It really is, but how do you know which one is right for you?
Yeah.
Right?
How do you decide?
So there's a few things you got to think about.
Okay.
First, you got to look at the cost of factoring.
Right.
Compared to other financing options.
Because those fees can be a little scary.
They can seem high at first glance.
Yeah.
But remember, it's all relative.
Okay.
Like if factoring helps you land a big client or avoid some huge problem, that fee might seem small compared to the benefit.
Okay, so it's not just about the cost. It's about what you're getting for that cost.
Exactly. Yeah. Will factoring help you grow your business? Will it let you take advantage of some opportunity?
Okay, so think strategically about it.
Exactly.
Not just, this costs this much.
Right. And of course, we can't forget about the creditworthiness of your customers.
Right, because that's really key here.
Yeah, if you're selling to big, reliable companies.
Like Walmart.
Yeah.
Government agencies, things like that.
You're in a good spot.
Okay, so your customers are like your financial safety net.
Exactly.
Okay, so what about the industry you're in? Does that matter?
It can, yeah.
Okay.
Factors, they tend to like businesses and industries that are stable with predictable income.
Okay.
They don't want a lot of risk, right?
Right. So like that electronics manufacturer we were talking about, all those product returns, that's a little risky.
Right. That's a more volatile industry.
Okay.
Things change quickly, lots of competition.
Yeah.
So the factor might be a little more hesitant.
Makes sense.
Now, your business's own financials, they're not the main focus. But the factor will still want to take a look.
Okay.
Just to get a sense of how you operate.
Right.
Looking for any red flags.
So like big losses or something?
Exactly. Yeah. Tons of debt, legal problems, things like that.
Okay.
That could make a factor think twice.
Okay. So it's not a completely free pass.
Yeah.
But it's definitely more forgiving than traditional lending.
Right.
Okay. Anything else we should know?
Yeah, don't forget about those factoring agreements.
Right. Those are important.
Yeah, they can be tough to read. Lots of legal language.
Oh, yeah. Get a lawyer.
Absolutely, yeah. Make sure you understand your rights, your responsibilities.
Okay.
And any potential problems.
Good advice.
You gotta know what you're getting into.
Yeah.
So, yeah, lots to think about with factoring.
So when is factoring like the best solution? When does it really shine?
Good question. So, first up, businesses that are growing really fast, they're doing well, they're getting lots of orders, but they might not have the cash flow to keep up.
Right, they're growing too fast for their own good.
Exactly, yeah. So factoring can give them that boost to keep up with the demand, hire more people, invest in marketing, all that stuff.
Right, gives them the fuel to keep growing.
Exactly.
Okay, what else?
Businesses that are facing a short-term cash crunch, maybe they have a big unexpected expense or their customers are slow to pay.
Right, like a little financial hiccup.
Exactly. Factoring can help them bridge that gap.
Okay.
Smooth out their cash flow.
Like a financial Band-Aid.
Yeah, exactly.
Okay, so we've got the fast-growing businesses with cash flow problems. What about those companies we were talking about before? The printer with all the debt.
Right.
The software company after the merger.
Yeah.
The electronics manufacturer with all the returns.
Yep, right. Factoring could be a great solution for them.
Right, because they might not qualify for a traditional loan.
Exactly.
So factoring kind of steps in and saves the day.
Exactly. It's all about finding the right solution for the specific situation.
Right. It's not one size fits all.
Right.
What about startups, new businesses?
Yeah, those are another great example.
Okay.
They have all these great ideas, but they don't have a track record.
Right. They haven't been in business long enough.
Exactly.
So banks might not want to lend to them.
Right.
But factoring looks at the customer, not the business.
Exactly.
So if a startup is selling to like a Fortune 500 company, that's a good sign for a factor.
Absolutely. It's like they're saying, we believe in your vision.
Right.
We trust your customers.
That's cool.
Yeah.
Okay, so what about those businesses that have like ups and downs throughout the year?
Right. Seasonal businesses.
Yeah.
Like tourism, retail,
Right.
Factoring can help them manage those peaks and valleys,
Okay.
give them extra cash during the busy times,
Okay.
and then they can scale back when things slow down.
Okay, so it keeps things more stable.
Exactly.
Okay, what about supply chain issues?
Yeah, that's a big one these days.
Right.
Like that chicken supplier we talked about.
Oh, yeah.
They had to totally change their packaging.
Right.
Because of supply chain problems.
Right.
Factoring gave them the cash they needed to make that adjustment.
Okay.
Find new suppliers, change their production process, even explore new markets.
It gives them options.
Exactly. It helps them adapt.
Okay, so we've got fast-growing businesses with cash flow problems, startups, seasonal businesses dealing with supply chain issues. What about acquisitions?
Oh, yeah, that's another good one.
Yeah.
Buying another company, that takes a lot of money.
Yeah.
And traditional loans, they can be really slow.
Okay.
Lots of restrictions.
Right.
Factoring can make things a lot easier.
So it gives them the flexibility to move quickly.
Exactly.
Okay, so we've talked about a lot of the good things about factoring, but are there any downsides?
Well, like anything, it's not perfect.
Okay.
You got to be aware of the potential downsides.
Okay, like what?
Well, the fees, like we talked about, they can be higher than traditional loans.
Right.
So if your profit margins are already thin,
Yeah.
factoring might not be the best option.
Okay, what else?
You could lose some control over your customer relationships.
Okay, how so?
Well, with notification factoring,
Right.
the factor's the one collecting the money.
Oh, wait.
So you're not really interacting with the customer as much.
Okay, so that could be a problem for some businesses.
Yeah, especially if you pride yourself on good customer service.
Right.
So it's important to choose a factor that has a good reputation for handling collections professionally.
Right, you don't want them to damage your relationships with your customers.
Exactly.
Okay, and of course there's always the contracts.
Right, those factoring agreements. Make sure
Yeah.
you understand everything.
Get a lawyer.
Yes, absolutely. Make sure you understand the fees, the terms, all that stuff.
Okay, so knowledge is power.
Exactly.
Okay, any other downsides?
I think that's the main stuff.
Okay.
But just, be careful.
Right.
Do your research.
Don't jump into anything without thinking it through.
Right, exactly.
Okay, good advice.
Yeah.
Okay, so we've covered a lot of the theory behind factoring, but I think it's time to see how this actually works in the real world.
Yeah, let's look at some examples.
Right, because our source material has some really interesting stories
Oh, yeah, for sure.
about how businesses have used factoring to solve problems and grow.
Definitely.
So let's start with a pretty common one, a company that's growing really fast, but they're struggling to keep up financially.
Yeah, like they're running out of cash.
Right, exactly.
Okay.
So Chris Lands talks about this consumer electronics company, and they were having all these cash flow problems because of product returns.
Oh, wow. So their product was good.
Yeah, it was a good product. They had good customers, lots of potential.
But the returns were killing them.
Yeah, and the bank wouldn't give them more money.
Right, because of the returns?
Yeah, it was like a vicious cycle.
Oh.
They needed more cash to manage the growth.
Yeah.
But the growth was causing the cash flow problems.
Yeah.
So they were kind of stuck.
So what did they do?
They turned to factoring.
Okay.
They sold their invoices, got the cash they needed, and that gave them the breathing room to scale up their production, streamline their returns process, and basically get back on track.
So factoring saved the day.
Yeah, pretty much.
Okay.
Okay, so let's look at another scenario.
All right.
A business that's going through a tough time.
Okay.
The source material mentions this security software company that had a merger that just totally flopped. Yeah, they put a lot of money into this merger,
Right.
hoping it would make them like a giant in the industry.
Of course.
But it all fell apart, and they were left in a really bad spot.
So what happened?
Their revenues tanked. The bank was getting nervous.
Right.
They needed cash, like yesterday.
Yeah, it's a tough spot.
Yeah, and factoring's came to their rescue,
Okay.
gave them the money they needed to kind of stabilize things,
Okay.
allowed them to regroup, focus on their core business, and eventually they recovered.
Wow. So factoring was like their safety net?
Yeah, exactly.
I like that.
Okay, so let's talk about supply chain disruptions,
Okay.
because this is a huge issue for businesses these days.
Oh, yeah, definitely.
And our source material is a perfect example.
Okay, which one?
Remember that chicken supplier Chris Lenz mentioned?
Oh, yeah, the one that had to change their packaging.
Right. So they had this great product, loyal customers, a good reputation, but their whole business model relied on this one specific supplier.
Okay.
And then, boom, supply chain problems.
Oh.
They couldn't get the chicken they needed.
What did they do?
They had to find a new supplier fast. But the new supplier had different packaging.
Right.
Like smaller portions ready for consumers.
Okay.
Which wasn't ideal for their restaurant clients.
Right.
But it gave them an idea.
What's that?
Why not sell directly to consumers?
Oh, interesting.
Yeah, so they had to invest in new equipment, new packaging.
Right.
And of course, they needed money to do that.
So they factored their invoices.
Exactly.
Smart.
Yeah, and that allowed them to make this big change, turn a problem into an opportunity.
Wow, that's a great story.
Right.
Yeah, it shows how factoring can help businesses be flexible,
Exactly.
adapt to unexpected challenges.
Okay, so these examples show that factoring can be used in so many different ways.
Right. It's not a one-size-fits-all solution.
Yeah, it's like a financial Swiss Army knife or something.
Yeah, I like that.
Okay, so we're almost done with our deep dive here.
Okay.
But before we wrap up,
Yeah.
I want to give our listeners some practical advice. Like, if they're thinking about using factoring, what should they keep in mind?
Oh, great idea.
So first of all, don't just go with the first factoring company you find.
Right. Do your research.
Yeah, shop around, compare rates and terms.
Mm-hmm.
Find a company that's a good fit for you.
Yeah, look for experience, good reviews.
Right.
Make sure they're transparent about their fees.
Yeah, and don't be afraid to ask questions.
Oh, yeah, ask lots of questions.
The more you know, the better.
Exactly.
Okay, another thing. Really understand that factoring agreement.
Yeah, those contracts can be confusing.
Right, so get a lawyer to look it over.
Absolutely.
Make sure you understand everything, especially the parts about recourse, notification, fees, all that stuff.
Yeah, you don't want any surprises.
Right.
And if you're using notification factoring, talk to your customers.
Okay.
Let them know what's going on.
Right. Be transparent.
Yeah. Explain that you're working with a factor, how it's going to affect their payments.
Right. So there's no confusion. Okay. And if you're new to factoring,
Yeah.
start small.
Good advice.
Yeah. Try it out with a few invoices first. Get a feel for how it works.
See if it's a good fit for you.
Right.
And then you can always do more later.
Okay. So remember, factoring is not just a quick fix.
Right.
It's a tool that you can use to manage your cash flow
Help you grow your business.
and deal with all the challenges that come up.
Absolutely.
Okay. So that's our deep dive into factoring.
That was fun.
I hope you learned something new today.
I know I did.
And if you have any questions about factoring or anything else related to business,
Yeah.
don't hesitate to reach out.
We're here to help.
Okay, until next time, keep learning, keep growing, and keep diving deep.
Sounds good.